Revenue growth remained a key driver of performance across all regions. Revenue reached $5,988 million, reflecting a year-over-year increase of 10.7%. Operational efficiency also improved, although at a slightly slower pace than revenue expansion. EBITDA reflects the company's ability to scale while maintaining cost discipline. This reached $2,381 million, marking an 8.0% increase year over year. The result highlights continued strength in Adobe's core operations. Net income continued to expand, supported by disciplined cost management and strong demand. Profitability remains solid, although growth has moderated compared to previous periods. It reached $1,772 million as for net income, representing a 5.2% increase. This confirms the company's ability to generate consistent earnings. From a margin perspective, Adobe remains highly profitable relative to peers. Net margin reflects slight pressure due to rising operational complexity. This stood at 29.6%, down from 31.1% in the prior year. The change indicates a modest decline in overall profitability. Earnings per share continues to demonstrate strong value creation for shareholders. The improvement reflects both operational growth and efficient capital allocation. EPS reached $16.41, improving significantly from $11.96. This trend supports long-term investor confidence. Valuation metrics have normalized following previously elevated levels. The PE ratio indicates a more balanced market outlook toward Adobe's growth potential. This currently stands at 21.7, significantly below last year's 41.8. The decline suggests a shift in investor sentiment. Similarly, revenue-based valuation metrics have also adjusted downward. The price-to-sales ratio reflects a more conservative market approach. It reached 6.52 as for the PS ratio, compared to 10.80 previously. This indicates reduced premium pricing on revenue growth. Asset-based valuation shows a comparable trend. The PB ratio highlights investor perception of asset efficiency and long-term returns. This came in at 12.85, declining from 15.55. The movement suggests a more cautious stance on valuation. Operating performance remains strong, with steady improvements in profitability. EBIT reflects the company's ability to generate earnings from core operations. This reached $2,173 million, compared to $2,109 million previously. The increase aligns with long-term growth trends. Cash flow generation continues to support Adobe's strategic flexibility. Operating cash flow remains a key indicator of financial strength. This increased to $2,198 million, reflecting an 8.8% improvement. Strong cash generation underpins further investments. Investment activity has increased, signaling a focus on long-term growth initiatives. The investing cash flow shows a significant shift compared to previous periods. It declined to $-279 million as for investing activities, indicating higher capital deployment. This may support future expansion. Financing activities reflect improved capital management. Reduced outflows indicate a more controlled approach to funding and shareholder returns. Financing cash flow improved to $1,876 million, representing a 23.5% reduction in outflows. This supports financial stability. Liquidity has improved, enhancing Adobe's resilience to market fluctuations. Net cash flow reflects overall cash position changes. This reached $43 million, compared to a negative level previously. The improvement highlights stronger financial flexibility. Balance sheet dynamics show moderate adjustments in asset structure. Total assets reflect the company's overall scale and resource base. This stood at $28,754 million, marking a 3.6% decline year over year. The shift may indicate strategic reallocation. Receivables increased significantly, reflecting higher business activity. This category is important for working capital management. It reached $2,093 million as for receivables, representing a 16.1% increase. Efficient collection will remain critical. The company's capital structure shows increased reliance on long-term financing. Long-term debt is a key indicator of leverage. This rose to $6,200 million, highlighting a notable increase. The change supports ongoing investments but raises leverage considerations. Leverage metrics remain within acceptable ranges. The debt-to-EBITDA ratio reflects the company's ability to service its obligations. This stands at 260.4%, showing a slight improvement from the previous quarter. The trend indicates better earnings coverage. From a broader perspective, overall leverage remains conservative. The debt-to-assets ratio highlights financial stability relative to total resources. It reached 21.6% as for this metric, indicating a strong balance sheet. This supports long-term resilience. Equity-based leverage also remains balanced. The debt-to-equity ratio reflects the relationship between financing sources. This came in at 52.7%, remaining within a healthy range. The structure supports sustainable growth. Profitability relative to shareholder capital remains strong. Return on equity is a key measure of value creation. This stands at 59.1%, slightly below the previous quarter. Despite the decline, the level remains high. Asset efficiency continues to be solid. Return on assets reflects how effectively the company uses its resources. It reached 24.2% as for ROA, showing a slight decrease. The trend remains stable overall. Operational efficiency has improved slightly in the recent period. Operating margin highlights cost control and pricing effectiveness. This increased to 36.3%, reflecting improved efficiency. The company continues to manage expenses effectively. Short-term liquidity remains strong. The quick ratio indicates the company's ability to meet immediate obligations. The level confirms a solid liquidity position. Working capital dynamics have improved significantly. Net working capital reflects short-term financial flexibility. This reached $173 million compared to a negative level previously. The improvement supports operational stability. Efficiency metrics show gradual improvement in asset utilization. The asset turnover ratio reflects revenue generation relative to assets. Valuation based on discounted cash flows provides insight into intrinsic worth. The DCF method estimates future cash generation potential. This results in $340.64 per share, suggesting slight overvaluation. Market pricing remains close to intrinsic value. Alternative valuation approaches offer a different perspective. The Graham method provides a simplified intrinsic value estimate. It reached $549.60 per share as for this model, indicating potential undervaluation. This highlights differing assumptions across methods. Financial stability indicators confirm a strong position. The Altman Z-score assesses bankruptcy risk and solvency. This stands at 15.03, placing the company in the safe zone. The result reflects low financial risk. Additional scoring metrics support this assessment. The Piotrowski F-score evaluates operational efficiency and financial health. This reached 6 out of 9, indicating moderate strength. The company maintains a balanced financial profile. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.